And here at the IEF headquarters in Riyadh, Bob McNally joins us now from Washington, from the Rapidan group. Bob, tell us the importance of this dialogue. You know, when you look at your accounts and your reports, how important is it that this dialogue is actually going on?
Extremely important, Etne, because it's the one place where we try and harmonize these varying outlooks on the oil market. And what is more important than the oil market for economic health, geopolitical stability, and so forth? It's the only place where we're doing it, bringing together the IEA, OPEC, even EIA and some of the major companies. Everyone who's trying to count barrels, understand the market. This is the one place where they come together and work together to try to harmonize differences and understand what's going on. Absolutely crucial work that the IEF is doing.
Now, let's have a look over the proceedings so far. I mean, there's been a few hours of dialogue in there. What are the key things that are emerging, and what are you finding that's actually very interesting here?
What's very interesting, especially when Richard Newell at the end started pointing out differences between the IEA and OPEC, is those differences that are really important. For example, the IEA is well above OPEC in terms of demand for oil. And this is really important. According to the IEA's forecast, if the IEA is right, we're going to be drawing stocks in the first half of this year. But if OPEC barrel counters are right, we won't. So there's an important difference that came out at the end there. And that prompted, I think, questions, understanding why are the demand baselines so different and so forth. A lot of questions about shale oil, how productive, how fast will it grow. So all of that really coming out later in the sessions, really very helpful.
And again, having these different outlooks, again, that really, I think, helps well, give you all a different perspective as well. So perhaps something you hadn't thought about before. And while these outlooks are maybe different, then we look at the private sector, and maybe your outlook is a little different as well.
Absolutely. And what I think you're seeing here is folks saying there are things we'll always differ about. Technology, productivity, demand, but we should try and isolate things that we shouldn't maybe be differing about too much. GDP growth, definitions of fuels. So what's really helpful here is people are starting to understand, let's see if we can't separate these things and sort of stipulate to them, and then really debate and look at the things that we have to debate going forward to understand the evolution of the oil market. Things like, again, policy-driven efficiency gains, productivity of wells, cost of wells. That's what we need to be debating. We should issue maybe reports at the same time using common definitions so we can understand our differences and maybe move towards better understanding of the market.
So here we are, the first quarter of 2017. Now the OPEC, non-OPEC agreement has been in place, and what we're hearing in the market really is there seems to be consensus that this is actually working. Tell us from your point of view, how do you feel?
Well, I think there's no question Saudi Arabia and some of the OPEC countries have cut dramatically. Saudi Arabia by more than folks thought. And on a percentage basis, compliance is quite high. But it really is about, I think, some of those key countries in OPEC that have provided the bulk of the cuts. So there's no question we have cuts from the producers. However, there are being increases from Libya and Nigeria and other places. And shale oil is proving very resilient. So the jury, I think, is very out. I think people are very cautious, and appropriately so, about whether and how soon we're going to begin the rebalancing. We're in the more skeptical camp. We'd want to see sustained draws in inventories, but reasonable people can differ right now.
And again, when we look at the state of the market, I mean, it's been volatile, it's been uncertain. I don't think that's going away, but we are seeing a bit of a sense of stability coming back in.
No question. Volatility in oil prices has come down. Folks are beginning to think that we've turned the corner. The decline in OECD inventory since the middle of last year is giving hope to some to think that we're beginning to rebalance and stability is coming in. The risk of another return to $26 a barrel where we were just 1 year ago, that is seen as less likely. So I think that's an accurate assessment.
And again, we look at the demand projections in the year ahead. I mean, we're still the demand is going to grow beyond 1 million barrels without a doubt. And I think OPEC's monthly oil market report, even just this month for February, was saying 1.2 million for 2017. The demand strength is still there, but we're still looking at a bit of oversupply in the market, yeah?
I think that's right. The demand strength is there, and particularly in OECD Europe, which came out this morning in the conversations. A bit of a surprising peppiness to demand there. But then questions about India, where they're swapping out their currency, and there's a bit of a slip in January. So always things coming and going with demand. But as you said, demand has been surprising to the upside. Forecasts range between 1.2, 1.3, 1.4 million barrels a day. With these low oil prices, we could probably see more upside demand, especially if there's sort of fiscal expansion in the United States and we get a little oomph to GDP growth. So I think folks are optimistic on demand, but rightfully cautious, as you mentioned, about this oversupply, this glut that's still 300 million barrels above the 5-year average that's hanging on with us. And it's that supply growth that may delay the sort of reduction of that towering glut.
So we all need to still be keeping an eye on what's going on in the US, because that when that price gets a little healthier, they do get rather excited and get back into the market, don't they?
Oh, I'll tell you, we have clients and we know folks down in the shale patch. They are raring to go. They are, as we say, locked, cocked, and ready to rock. And if that oil price stays down at $55 or $60 a barrel, I think you'll see surprising upside to U.S. crude production.
And when that happens, is there a danger we go back down again in price?
Absolutely. Shale it may be a bit of a disruptive factor in terms of helping us get to stability. OPEC will have to reconsider if shale looks like it's coming back towards 1 million barrels a day, especially if they pass this border adjustment as part of tax reform in the United States. That would further boost shale oil production. And so OPEC may be contending with a sort of a unwelcome and strong return of shale oil production, and from a market balancing standpoint, it could be complicating.
Would you be in the camp that would suggest perhaps that this agreement be rolled over for another 6 months at least?
I think at least. I think Saudi Arabia and some of the key Gulf producers will probably decide to extend the production agreement. I'll be surprised if we see a further round of cuts, but I wouldn't rule that out. But I think extension right now is most likely. I sense there's a creeping caution about how quickly stocks will rebalance, and I think the question of extending is going to rise in the deliberations going forward.